Hello again, everybody. This is Bill Warner. We're still in week 5, and in this module, we're talking about financing your business, and we're going to go through the various alternatives that might be available to you depending upon your financing need and your readiness, and quite frankly, attractiveness as a business to qualify for financing. So let's get on into it. So to summarize again where we're at, we're still in step 4, evaluation, finishing a business plan, and the aspect we're now working on is the financing of your business. Okay, this in one slide shows financing options or financing alternatives based upon maturity of your business. So imagine on this slide, moving from left to right, and the left side is the most immature early stage business, some business at what's called the seed stage, pre-proof of concept. They're in steps 1, 2, and 3 in our 6-step to success language. The second level of maturity is creation. That is, they've moved into proof of concept. The third level of maturity, about the middle of the page here, is we've started up, we've launched the business. The fourth level of maturity is the business is up and running, and now we need money to expand the business, perhaps into new markets or with new products. And the fifth, the most mature stage, way over on the right here, is the late stage of a business that is perhaps going to sell to another company or merge with another company, or it needs a lot of money, many millions, for example, in order to expand perhaps worldwide or into several new markets or buy another company, big time dollars. So given those 5 levels of maturity, here are some of the options that we're going to be talking about as things you could consider for financing. So going back to the earliest stage, ideation, or the seed stage of a company, look, the first and foremost way of financing it is bootstrapping it. It's founder owned, and the founder will own 100% of the company, so it's selling any part of it. Bootstrapping the business along the way, but the financing comes out of his or her pocket. Grant financing is available for this stage, from foundation grants, for government grants, particularly for nonprofits, but for-profit tech companies and life science companies, grants are available. They take a long time to get, but they're grants. You're not borrowing it. You don't have an obligation to pay it back, but you do have a lot of reporting to do. Next one is crowdfunding, particularly rewards-based crowdfunding or donation-based crowdfunding. That's Kickstarter and the like. You can get some funding for an idea. Okay, then moving to, say, the creation stage, and you're into proof of concept. This is the world of friends and family. You've heard that term before, friends and family and fools, where you could consider getting equity or debt financing under modest terms done by people that probably know you well. This is also where crowdfunding debt instruments become available to you. Of course, you have to have collateral and you have to make payments on it, even though you're getting it from a large syndicate via a crowdfunding debt platform. And then non-bank financing institutions also come to play, but again, collateral is required and payments, of course, are going to have to be made. Hardly, even though I show banks in this chart, quite frankly, very few banks, only very specialized banks, are going to even entertain this idea. In this third level of maturity, startup, where the money is used to launch the business, this is where private individuals as angel investors or the angel investor groups can come to play, and that is usually preferred equity financing. Equity-based crowdfunding can also apply here. It's very early for one, but it's possible. Strategic partners and customer funding to help you launch your business, become available to you. But these later stages for expansion of the company and the very late stage of an IPO or the acquisition of another company, very large financing. Institutional investors are going to be involved. The venture capital world, the investment banking world. I'm not going to talk any more about institutional financing after this chart. It really is not going to apply to most any of you, and when it does, if it ever does, you can learn about it then. So that is kind of the landscape of financing alternatives that you can consider based upon the level of maturity of your business. So let's start going through these. First one I mentioned was founder financing. This is where the founder of the company or the group of founders have enough money to at least get the company off the ground in the first place. Get it through creation and perhaps even launch it, at which time they may want to bring in other money after that launch phase has occurred. But the bootstrapping kind of approach to things apply here. Services businesses are usually the easiest to start, and the reason is they don't require a whole lot of money to get moving. You don't need to make something. Creation phase is the development of a methodology, and you can build a services business one customer at a time, and you get paid up front, or a good amount of what your fee is up front. So there's no capital spending needed usually. The smart entrepreneurs delay lease payments. They negotiate, 2, 3, 4 months of upfront free lease payments for consideration of paying it all back on the back end of the lease term. The products and the cost of goods are paid for by sales revenue. I mean, that means you're collecting revenue before you make a product. That's a good habit to get into. So that's all about managing cash flow. So make enough money to pay for manufacturing before it starts. That's another bootstrapping technique. The owners and the initial employees, the founding employees, take very little salary, in some cases none at all, and in consideration for probably equity in the company. They become part owners, or founder equity is what the term is. So revenue should precede expense in this kind of bootstrapping techniques, and you avoid paying the bills as much as you can without undue stress and people taking you to court because you're not paying your bills. That's pushing it too far. So your sales and your services, if that's your business, are instantly cash flow positive. That's all about bootstrapping. And those techniques apply to running most any business. But in this case, we're talking about a founder or a group of founders getting together, pooling their money, and taking these kinds of actions to start the business without spending a whole lot of money. So now let's talk about friends and family. Now, when you want to consider asking friends and family and other business associates that you've known or worked with in the past, you have a particular advantage in that they know you, they trust you, they believe you have high integrity, they believe you're going to do what you say you're going to do, and they believe you're going to pay them back. So friends and family are wealthy associates, wealthy family members. They should be accredited investors in accordance with SEC guidelines. And the SEC guidelines define what accredited investor is. And it has everything to do with their net worth. So they know and trust you, of course, but they're going to have no involvement in your business. On average, they generally invest as little as $5,000 or upwards to very large amounts, like $50,000, $25,000 to $50,000. That's not unheard of for friends and family kind of financing. And if you collect 25 to 50 from 4, 5, up to 10 people, you're going to have a lot of money to get your business started. They're not usually professional investors. We'll get to them later. So the terms that you're going to see from friends and family are going to be a lot more favorable to you. And it's going to take you a whole lot less time to convince them to invest versus people who don't know you. So the reason they invest is they want to help you. and they want to give back to the entrepreneur community because they have the net worth to do it, and you're a friend. And who else would they want to help more than a friend? But you're going to treat them as if they were professionals, give them a fair deal, and follow through on what you say you're going to do in terms of reimbursement to these people, or else Thanksgiving dinner is going to be a little difficult if you don't pay them. With respect to debt financing, what I'm going to talk about is non-bank debt financing. These are financing institutions. Some are nonprofits even. Most are for-profit organizations that find private money, in other words, and make it available to people who are credit worthy enough to borrow it. So these are private banking institutions, in some cases private individuals. Friends and family can be a loan as well as an equity investment in your company, either one. The uses of the funds are for equipment and mortgages or prepayment of the lease terms, building up fit if you can't negotiate it into the lease, but many, many other things having to do with operating expense that are going to take you for a period of time to the point where you can float your own boat, have enough money coming in to pay your bills. So the considerations for qualifying for this kind of financing are you must have good credit. You can't run from it. Anybody who owns 20% or more of the company is going to be looked at. If they have bad credit, you can almost forget about qualifying for any loan from anybody. Collateral is going to be required. That may take the form of a personal guarantee by some of the founders, if not all of them. You have to have proven and reliable financial results. Well, wait a minute, we're a startup here. How can we do that? Well, you can show such things as you've managed money well in other situations you've been in previous companies. So you show that you know how to do this and that you have paid people back in the past. They rarely do finance startups, but some do. So this availability of debt financing exists for you from seed round all the way through the life of your business. So depending on the amount and the risk they see, they're going to qualify you, and many times under SBA guidelines, which almost brings them to the level of qualification of a bank. But believe me, these non-bank financing institutions are not regulated, so they can make judgments based upon meeting the founders of the company and deciding for themselves what kind of risk they're going to take. Now, if they're going to take more risk than a bank, the interest rate's going to be a little bit higher, so expect that. But getting debt financing, even at the seed stage, is possible. Sorry, at the startup stage is possible. Relatively new in the financing world over the last 2-3 years is crowdfunding. Crowdfunding has come on like bandits going after the gold. There are hundreds, there are literally thousands of crowdfunding platforms now in the industry. They are organized by all sorts of industries, type of financing, type of involvement of the investors, syndicates of investors grouping together within a crowdfunding platform, and the list goes on. But what this comes down to, there's two types of crowdfunding, generally speaking. First is reward-based. That is, you put up a crowdfunding campaign and ask for donations or contributions to your business or your social cause, which is usually more appropriate for these rewards-based campaigns. But typical are Kickstarter and Indiegogo and literally hundreds and hundreds of others that you can choose from. The key here is to pick the platform that's right for your industry and your cause and the type of business that you're in. Do the research to figure out which one should you go out on. And these can be very lucrative. I've seen startups with not much more than an idea raise tens of thousands, and in a couple of cases, a couple of $100,000 in a rewards-based campaign. The second type is investment-based. That's either debt or equity financing. Equity financing, of course, being buying stock in your company. Debt, of course, is loaning you the money and you having the need to pay it back. So these platforms, these investment-based crowdfunding platforms, syndicate equity amongst lots of different investors, and they do that for debt financing as well. Since solicitation is allowed, you're now allowed to go out and solicit for, and almost as if you're doing a public offering for your business. And non-accredited investors are allowed, which has not been the case up till we recently had these equity-based platforms. But these are, again, there's hundreds and hundreds of these as well, all organized by different industries and different kinds of investors, different preferences for investors. You got to do the research to pick the right one. Seek out some experts to help guide you. But at the end of the day, you got to have one hellaciously good campaign to get noticed, let alone get some money donated or loaned to you. You got to have a solid plan that you can refer to and point them at. You got to have a really, really compelling video, and perhaps several. Some exist on your campaign, some exist back on your website, really demonstrating the compelling interest that they should have in what you're going to be offering as a product or service. Your website's got to be well done, simple to understand, well designed, responsive, with action-oriented steps that people could take to provide a donation or invest in your business. The social media outreach has got to be voraciously compelling and wide-reaching. You've got to seed your campaign with a whole lot of early on interest in what you're trying to do, and keep that going through the whole duration of your campaign. Email campaigns to help kick it off are going to be very important as well. So you're suiting up all of this social media and email outreach prior to the launch of your campaign, such that when you hit the button, go, let's start the campaign, the social media outreach starts immediately and in high volume. You, of course, also, believe it or not, even though you're going to try to ask for, say, $50,000, you've got to have some of that spoken for, upwards of 20 to 30% of it, prior to the campaign starting, so that when you start, several people, upon your instance, your notification of them, they make their donation or they make their investment in the first day or two, such that any other people look at the campaign can see that it's getting a lot of traction. And traction, good traction, leads to more good traction. So you got to kind of seed the campaign to get it moving. There are all sorts of these best practices, but these are the major ones. This is a lot of work in order to be successful. It's kind of the message I'm trying to get across to you. But it can be done. It's been done many, many times. You possibly could do it too. Okay, who are these angels that I've mentioned earlier? Well, they're private individuals. They're accredited investors. They're high net worth individuals. They are former entrepreneurs, experienced executives in corporations. They have run businesses themselves. They have a range of involvement because many of them have some free time and they want to help. So they could be your lead investor. They could become your chairman of the board. They could become an advisor as an investor. Or they could simply be passive, give you the money, and want reports now and then. Ranges all over the lot. Most of the time, these people do not become active in your company at all. But the general investment range for the private individuals or angels or angel groups is $25,000 to $250,000. I think the average angel round is about $230,000 these days, according to the Angel Capital Association. Angels are involved in many deals, so they're diversifying their portfolio of angel investments, knowing that, quite frankly, only a few are really going to work out. Despite the brilliance of all you entrepreneurs, believe it or not, more than half of these investments will be dead zero losses in 3 years. By 5 years, only 1 out of 20 are going to be that big giant home run that saves the day for all the previous losses. All the rest are going to be 2, 3, 4 times return on their investment, leading to a very attractive portfolio that returns in aggregate maybe high teens in terms of a investment return over a 5 to 6 year period. But why do they do this? This is crazy. This is highest risk kind of investment there is. But it's only going to be part of their comprehensive portfolios, less than 3 or 4%. So it's not like they're going to lose their life savings. It's kind of mad money. But they love putting it to work. They love the action. They want to give back to the community. They've reached a point in their careers they want to help. But the returns are good if they're really smart about it. And there's some pros that are really good at this. But you need to have an exit for them to get the return that they're looking for. An exit being that your company gets sold and these investors can cash out. That's the name of the game with angel investors or angel investor groups. Very briefly, strategic partners could emerge anytime across the spectrum of the maturity of businesses. These are companies that would be complementary to your business model, add value to it. They really like what you're doing. They want you to be part of them, or they want to be part of you. But together you provide extraordinary value add, and more so than you would do individually. So in this case, the partner provides some cash and or services in consideration for equity in your business or royalty payments, as if it were kind of a loan, but royalty payments from you off of your early revenue. Or you provide them services that they need, that they don't have, or you give them preferential pricing of the products that they ultimately want to use. So it's a tit for tat here that they give you money, invest in your business, and you give them something in return, and everybody's happy. Customer financing goes along the same lines, where a customer sees a significant future need of your product and wants it fast and wants it now and wants it in some preferential way. So your product or service provides them needed value and would perhaps provide them differentiation from their competitors. And they might be willing to pay you money to get your product up and running. And in consideration for preferential pricing, this sounds familiar, right? Payments, pay them back over some period of time, royalty payments, some percentage of revenue, services done by your part that are worth money, or you simply sell them equity in your company just like you did the angels. So there's all sorts of alternatives for compensating them. But keep in mind, your first few customers, one or more of them, could possibly be early investors in your company. So keep your eye out for that. Well, that's it for financing. So in class or your mentoring session, you're going to be discussing your marketing strategy and your sales strategy, and of course update your elevator pitch again for possible presentation in the next class. But for the next session, complete the financing strategy template, provide it to your mentor for review, and discuss in your next mentoring session, along with further updates based upon what you've done in your financing strategy to your elevator pitch. Okay, that's the end of this module. Now, if you have questions, go ahead and contact your instructor, mentor, and your choices for doing that are, you can email your instructor at innovationcenter@faytech.edu. You can make a call at 910-678-8496. And you can schedule a meeting with your mentor in the virtual office on Blackboard. You can also post a question on Question for My Mentor discussion forum and have others participating in the answer to the question. It's a good way of sharing information amongst participants. But please note that you should not post a question that is divulging confidential information that would open up that confidential information to others to read. So be forewarned there. So that's it. Get your homework done. Look forward to talking to you in the next class.